Okay, great. I think we're ready to get started. So we'll start with a quick introduction. My name is Tarina, and I'm on the venture team here at AngelList. I'm super excited to be kicking off the spring 2026 Demo Day webinar. During our webinar today, we'll start with a quick overview of what AngelList's Demo Day funds are, and then we'll get into some of the questions that were sent in for our fun leads. And before we get started, I'm just going to go over two quick housekeeping items. The first is that we'll be recording this webinar and we'll share it with all of you tomorrow through email. We'll also be uploading the recording to our AngelList YouTube channel. Second, we'll be spending some time going through some Q&As with the spring 2026 Demo Day fund leads. We had a lot of questions submitted in advance, but please feel free to drop any additional questions in the Q&A function on your Zoom bar. So towards the end of the webinar, we'll try to get to as many questions that you send through as we can. Perfect. Now that we have those logistics out of the way, we can go ahead and get started. Thanks everyone again for joining and showing interest in learning more about our funds for the YC Spring 2026 Demo Day batch. For those of you who are new to AngelList, we focus on building modern software and pairing that with premium services to help firms ranging from emerging managers to established firms launch new investment vehicles or streamline existing fund operations. And to give a quick introduction on Y Combinator, YC is one of the world's largest startup accelerators. In 2025, YC transitioned to a new schedule of 4 batches per year, allowing for more frequent opportunities for founders to participate in YC and present their companies at demo days. Several big companies that you probably are familiar with have participated in and graduated from past YC demo days. So where does AngelList come into the picture? Each quarter, in parallel with YC Demo Days, we have the privilege of supporting 4 esteemed YC alumni who are each launching a fund that gives you the opportunity to invest in the spring 2026 batch of YC companies. You can choose to allocate your commitment equally across all 4 funds, or you may also choose to invest in specific funds. The fund leads here will leverage their YC connections and experience to deploy that capital to what they see as the batch's strongest companies. So the purpose of our webinar today is for you to meet and hear directly from our leads. They're all YC alumni, experienced founders, and investors. So Ben, JJ, Nate, and Philip, thank you so much for taking the time today. We're super excited to have you here and to learn more about each of your investing philosophies and overall thoughts. To get started, I'd love to do a round of introductions so our audience can hear a little bit more about you and your demo day investing philosophy. As part of that, I'd love for each of you to touch on why you believe YC is one of the best places to invest in early stage startups and what keeps you excited about doing demo day funds. So Ben, we'll start with you and then we'll go in alphabetical order by first name.
All right. Well, thanks, Trina. Hi, everyone. So I am Benjamin Bryant. I've been running Demo Day funds since 2017. I've backed over 600 Y Combinator companies. I'm one of the most prolific investors in the program. I work doing this full time, specifically focused on VC. My background relevant to YC, I was a early participant in the winter 2011 batch of Y Combinator. Was an individual behind or one of the team members behind Pebble Smartwatch. And then before that, I spent 6 years as an HFT at 2 hedge funds. Earlier than that, I did a fair bit of computer vision research and AI research back in the late 90s and 2000s. Um, I have a degree of engineering from the University of Michigan and a master's in finance from London Business School. Strategy-wise, we really focus on building broad, diversified portfolios. Early stage returns, they're heavily power law distributed, which essentially means a small number of your outliers are going to drive the vastly kind of disproportionate amount of your portfolio value. And so we really cast very broad nets. We focus on, getting both kind of, we believe, the standouts of the batch, but also taking very calculated bets on, some of the contrarians, the dark horse positions, the bolder ideas, something that we kind of can uniquely do, package that up into a portfolio of around about 50 companies each batch.
Thanks, Ben. Super helpful background. JJ, go ahead and introduce yourself.
Hey, I'm JJ. This is my 10th demo day fund. Can't believe it's been that many already. One of the most active YC investors, one of the top on Bookface. Founders come up to me and they're like, "Oh, I've heard of you at events," which is cool, a little weird, but cool, I guess. I started a company in winter 15 called Way Up. We were the largest marketplace to help students and recent grads find jobs and companies to hire early career. I ran that company for about 7 or 8 years. I sold it in 2021. By the time I left, the company was around 150 employees. Right after that, YC invited me to come back and be a visiting partner. So I was there on the other side, running the program. I worked with over 100 companies, helped them raise a few $100 million in seed funding. Then when I left, I ended up becoming a full-time investor, which is what I do now. In addition to my work with YC, I run a go-to-market program for post-seed startups through Series B. So I work with startups everywhere from pre-seed during YC, where it's just an idea, if that, and the founders, to helping companies mature their go-to-market strategies through the Series B. I'm super well placed to know how to invest in YC companies. I both from having been a founder and then having been on the other side, like I know what it is like to think like a partner and why they did or didn't pick certain companies. I think it helps me a lot when I only have now we have 30 minutes to talk to a company. It's like a luxury from the 10 minutes I used to have when interviewing on the YC side. So I've been investing for 7 years now. I have a lot of early checks into great companies, like many of the most recent top YC companies, but also Ramp, DBT, Retool, High Touch, who just raised it over $1 billion, Reducto, many others. I before all that, I was in a specialized program at Penn for international studies and business. I then taught myself to be a software engineer when I started my company. So I have hands-on tech knowledge and business knowledge, all that. To answer the questions, YC is still the best place to invest in early stage startup, and like amazingly is becoming not only even better but probably taking over more of a share percentage wise of the entire seed market. So I think we're moving from YC was the best place and always has been to YC is the best place, always has been, and also may soon become the only place to really find really great seed deals. What keeps me doing demo day funds is I love YC founders, I love the YC ecosystem, and I'm just really passionate about being able to help everyone else get access. It just isn't the case that you can just go invest in YC companies today for better or for worse. And it brings me joy to be able to help people get access. And then for me to get to do that while talking to YC founders, which is really energizing.
Thanks, JJ. Nate, we'll go on to you next.
Well said, JJ. I'm Nate. I'm excited to be here. This is my fourth demo day fund. I've been investing in YC companies for about 6 years. In total, I've invested in a little over 150 companies. But before I became an investor, I was a founder. I did YC a couple of times. I was in winter 16 as well as summer 21. I tend to focus mostly on developer tools, fintech, SaaS, but I'm not afraid to do just about anything, whether it's refueling spaceships or data centers in space or biotech. In the portfolio, I'll take a few of those longer shot bets. In each batch, I typically invest in between 12 and 14 companies. In my full-time role, I'm the head of growth at a company called Numeral. And so typically where I spend the most time with the startups that I invest in is on the growth and go-to-market side of things. And that's typically where I'm most helpful. I love investing in YC founders. As an investor, it is just so energizing. And now more than ever, I'm convinced that YC pulls the best founders each year, each batch. And I think we see that in terms of the quality year over year. And I'm excited to be here. It's so much fun. And I'm excited to work with you all.
Amazing. Thank you, Nate. And lastly, but certainly not least, Philip.
My name is Philip Winter. This is my eighth batch investing in YC companies. I have been investing for the past 8 years, and I've done over 140 investments in YC companies. Some focus on deep tech. Outside of YC, I've also invested in Anthropic and in Perplexity. My investing is heavily informed by my days as a YC founder and an operator with 2 exits. I went through YC in the summer of 2015 with a company called Nebbia. Ran it for 9 years. We raised 4 rounds. Our first investor was Tim Cook. We also had investment from Eric Schmidt and Joe Gebbia. At one point, we had more money than we needed. At another point, we ran out of money. We eventually partnered with a leading public company in our industry, rebuilt it for another 4 years, and sold it to a strategic in 2022. And for the past couple of years, I've been working mostly as an investor in deep tech. Last year, I was also the CEO of another YC company that was from the summer of 2018 that had been backed by Khosla, sort of in the industrial biotech space, and we sold that in September. I have degrees from UPenn and Cambridge. I invest alongside two founders, Brian Chen, who was in the winter 2015 batch. He's a three-time founder, and Mike Hinckley, who is a former growth investor and product leader at Airbnb. We have a range of different backgrounds. We invest generally in about 20 companies per batch. We try to be early and fast, but also look for outliers at slightly different stages and not just go for the very hot companies. I often do an NPS question at the end of the interview, and it's for a couple of reasons. One is it kind of breaks the ice and it creates a more human connection with the founder. What is remarkable is how insanely high and resilient the NPS score is from batch to batch. And I firmly believe that YC continues to be the best pool for early stage companies. As an angel investor, it's really hard to build a wide enough portfolio in early stage. And as JJ was alluding to, I find it incredibly energizing and motivating to help democratize access to early stage private markets in what we think is the best pool to be investing in.
Thanks, Philip. Appreciate all the fun leads introducing yourselves. Now we'll dive into some of the pre-submitted questions. So for our attendees, don't forget to use the Q&A button to submit any additional questions that you might have during the webinar. So I'd love to start by getting to know each of you a little bit better as investors, specifically how you think about founders at the earliest stage before there's not so much to go on. So Ben and Philip, before there's any traction to point to, what non-negotiables are you looking for in founders and how do you best identify them?
Yeah, it's me. I don't really think there's, let's say, kind of particularly any, specific characteristics when we look at founders. Coming here, we're picking out a YC. So by the time we've got to demo day, or even the fact that a company's been, I want to say, invested at demo day, I mean, a lot of the, obvious noise has been filtered out for a founder. YC has a really kind of, repeatable characteristic of founder, and that comes through. And what I really would say would that be, tenacious individuals that, are in there for the long haul. I mean, I think when you look from the outside at a startup, you think that the model is really that, how should we say, you struggle for a period, you find success, and then, it continues on. I mean, I think the model that's more appropriate is you struggle, you find some degree of success, hit a plateau, you struggle some more, hit another plateau, hit another plateau. And it's the founders that really can, keep clearing that bar and keep persevering, that go on. So, I mean, when I'm on a call with a founder, what am I typically looking at? I'd say, first and foremost, it is, are these individuals, someone that's really going to be able to go the distance? I mean, do they exhibit passion? Do they exhibit drive? Or, is this the one and only thing that they want to do, which is predominantly most founders, and then outside of that, it's additional things like, can we package this up to ensure that, by the end of the demo day, they're going to have enough capital to get to the next stage, have the runway that they need. So I mean, it really is, it's not so much about picking companies or anything around there. It's really, whether you've got someone that, is willing to sign up for the next 10 years and just at all costs make it happen.
Philip, any additional thoughts there?
I think Ben's point on resilience is very good. And I'd build on that by saying, the question is what non-negotiables are we looking for if traction isn't there. Things that particularly stand out to me are an intensity, a particular and sort of well-backed insight into the industry or the problem that they're building in. What is their learning curve? So often like asking and either directly or indirectly, and trying to glean what are they learning? What have they learned in these 2 months? What did they learn before they got into the batch? Are they talking to customers at a high rate? Um, I really try and uncover their thinking and relative sophistication when talking about customer acquisition and how they're going to scale beyond the obvious answer, which is founder-led sales at first. Um, and maybe one other thing to throw in there, if there's a strong founder market fit, that is often a very compelling aspect for me, and I find myself drawn towards those.
For sure, that's super helpful, Philip. Thanks. JJ and Nate, is there something a founder can do or say in a first meeting that immediately tells you this is someone you want to back? Or on the flip side, is there anything that's an immediate no for you?
Um, the first, so much of it, surprisingly, is it's not just about the people, it's about the impression you get from them. And the reason it's not just like, oh, I like this person, the energy and fervor with which a founder approaches a pitch is pretty indicative of how they're approaching everything in the company, including management, hiring, sales. So it's pretty rare that there's something that is an immediate yes, I must back this person, because you always do need to do a bit more diligence. And I know all of the fund leads, we all do a ton of diligence before the meeting. So we come into the meeting with an opinion, and then the founder, the way that they act usually puts it over the edge or not. Things I really like to see, aside from energy, insight, a really deep knowledge of their space and their numbers. You can tell apart the founders who just know their numbers cold and can answer any question, and know when they have to say, hey, actually, this is a good question, let me come back to you, and then they actually get back to you afterwards. One word I like to use sometimes is feral. If I run across a founder who's like feral, I think to what Bones thinks, we'll stop at nothing, run through walls. I really, really like that. An easy immediate no is if they're not smart, or if they're combative. And combative is different than willing to push back. I love a founder who will tell me when I'm wrong, is confident, stands up for things. There are some founders who are surprisingly a bit toxically combative. They get angry if you disagree with them. Or their answer to like, I'm concerned this industry isn't big enough. Why do you think? They're like, oh, it just is. Those are pretty immediate no's for me.
Yeah, to echo what JJ said, the energy coming into the call, like as soon as the call starts, is very important. Oftentimes like we are some of the first folks that these founders are talking to. And founders will often, especially if they haven't fundraised before, like try to jump immediately into a slide deck. But I do like to try to pull it back a little bit and take a deep breath and say like, yeah, before we get into that slide deck, like who are you? Like what is your background? Like who are you as a person? And then we can talk about the business. And I guess there what I try to look for is like, has this person done something extraordinary? Maybe it's not like a business feat, but like maybe have they become like the absolute number one professional gamer in their game? Or did they graduate college at 16? Like that's kind of interesting. Like, and then the next question is often like, why did you do that thing? Or how did you do that thing? Like, it gives me some signal that like this person is not afraid to try to be the best, and has the ability to be the best in that thing they're trying to do. Um, Even if it's not business related. But yeah, the energy is just infectious. If you get on a call and there is not that energy, like JJ said, I think that is often, descriptive of everything they're doing with their company. As far as things like not to say, like one of my favorite questions to ask founders is like, why won't this business work? And like, or like, why won't you succeed? And like, I find that is often a very good filtering question because it shows me like how founders can think about like the different risks or challenges that they might face, or maybe they don't know that they will face, but could exist. When you talk to a founder and they're like, they don't have their answer could be like, we couldn't figure out marketing. Like that's not a good example, for example. So yeah, there are some questions you can ask, but by and large, it's energy, it's story, it's them being able to paint the picture of who they are. That gets me really excited.
Thanks, Nate. Sounds like the common thread through all of these is just the founder themselves and the ambition and the intention that they have with what they're building. Zooming out a little bit from concentrating on the person that you're speaking to, I want to talk a little bit more about industry and AI, as I'm sure a lot of our viewers are thinking about that. There's obviously a lot of excitement, but also a lot of questions around the current AI moment that we're in. So, Ben and Philip, there's a lot of noise right now about whether we're in this AI bubble. So, when you're looking at this batch of founders, how do you tell the difference between companies that are riding an AI wave versus one building something with real staying power?
All right, I'll hop in here. You know, I think bubble or not is probably the wrong way to frame the question. If you look at every major platform shift, there's always going to be bubble-like, or always has been bubble-like behavior around it. It doesn't mean that the platform shift itself is fake. You get a lot of capital coming in, you got a lot of talent coming in. There's also a lot of hype that comes in all at once, and I think it's hard to distinguish between the two. Um, at the end of any platform shift, I think the reality is, most individual companies are not necessarily going to matter. But there are going to be a few number of, companies that are going to, matter enormously in that kind of future ecosystem. So, the way I think about it is we're not really trying to make static predictions here. We're optimizing for adaptability. So it comes down to is, who's learning the fastest, who's got, the most intimate understanding of their customers, who's going to keep rebuilding, as the underlying models change, as the ecosystems change, as things shift over time. Ultimately it's, the winners when it comes through platform shifts, are not the people that make this perfectly forecasted, kind of predicted view of what the kind of final shape of the market bid. It's going to be the people that really were already in the market when the market started to move. To use kind of like a surfing metaphor, you're not going to catch the big wave if you're not already in the water, so to speak. And that's really look what our portfolios are doing. They're out there really, catching, reading it, and optimizing so they eventually are able to kind of bring it home.
Definitely. Philip?
Mm. I absolutely agree. Like this is about looking 10 years into the future. I think the AI bubble is not really relevant to the companies that we're building, and they're all AI native companies. Um, the bubble is potentially at the very top of the market, and maybe not. The frontier labs and um, the the valuations in AI feel high. They are higher than they were 5 or 10 years ago. But I think every one of us on this call would agree that the TAM is going to be so much larger than we're even predicting 10 years from now. And so it's like it's all scaling along those lines. Um, I think that the real staying power I look uh, for in the founders is insight. Is partly what I was saying earlier. Is there a reason they're building this particular AI native company? Or are they just talented, went through a list and picked a problem to go after? That for me is a red flag. It doesn't mean it's uninvestable, but I would want to dig in more to that. Like, will they have the genuine passion and or industry know-how and the sustained advantage to be able to pivot within a broad area that they've picked, if the particular idea doesn't get sufficient traction, which will be the case for a large percentage of the companies that we invest in. Doing a wholesale pivot to an entirely different industry or going from consumer to B2B, that's a lot harder. You're usually sort of pivoting within a general industry because a customer has told you, hey, I have this problem. Why don't you build for me in this side? I don't really care about what you're currently building. Um, And but there has to be a reason that you're building that space, a genuine passion. You've been in that industry for a while. Uh, those to me are things that really stand out.
Yeah. And Philip, I think that's a great segue. In the age that we're in right now, building is cheaper and faster than ever. So when we're looking at the AI moment that we're in, we can see that founders can ship a product in a weekend and then pivot to the next one just as fast. So I'm curious to hear from you, Nate. Does that raise the bar for what makes a YC company fundable? And then when product cycles collapse like that, does it push you more toward investing in the founder than the product? And if so, what are you looking for in founders now that you weren't 5 years ago?
I definitely think founders are moving faster than ever in terms of building product, but also traction. Um, I think it was Gary Tan, the CEO of YC. He tweeted a couple weeks ago, I think, that like in the winter 26 batch, which was the most recent YC batch, three times more companies in the batch reached over $1 million in annualized revenue than they did in the winter 25 batch. So companies are getting to a million faster than they ever have. And he also said it was crazy that the winter 26 batch had the fastest revenue growth rate in YC history, an average of 14% week over week on average across the 200 companies they backed in that batch. And so, anecdotally, yes, it seems like founders are moving quick. They're building, they're iterating, but then also, too, the data shows that they're actually generating revenue and growing faster than they ever have, according to Gary. So I think you're certainly right. But to that second point on the question, is the founder more important than the product? I think that's always been the case. And that's certainly how I approach things. Some of the best companies that I've invested in were pivots, but it's because there were great founders behind them. And so I index on the founder at these early stages more than just about anything else.
And JJ, so just building off of Nate's response there, is there anything that you're looking for in founders now that you weren't 5 years ago due to the current AI movement that we're in?
I think there are some things that are different, but if you take like a higher level view and look back many years ago, a lot of it is more flavors of the same. Like I think back to when cloud started being a thing, or back when we build on Heroku, and a lot of people at the time were like, "Oh man, everything's going to be so different because you don't need to build your own data center anymore, and like anyone can build anything now." And it both was true and wasn't true, right? Nobody, by no means would anybody say, "Oh yeah, building a business was like all of a sudden super easy." Just some things became a lot more easier. And I think fundamentally what that meant and means is the fundamentals of the business become more important and the founders become even more important. They were always important, but like who the founders are, their background, what the history of accomplishment, what Nate said, the knowledge of their space is much more important in a company's success than just them being able to build a thing that is hard to build. And hard to build itself becomes less of a mode, which I think is good because I don't think that's much of a, you know, not something I want to stake my company on. So I look for more of the same things that I always look for in founders, which is grittiness, knowledge, deep curiosity, and knowledge, connections in their space. And again, that feralness to do whatever it takes, even if whatever it takes is slightly different now. Maybe one thing that is changing now, if it feels different for people, is I do like to see in founders a thoughtfulness about what is different. Because of how quickly this has changed, which is different than the cloud or mobile transition. This has been like over a year, basically. So founders should at least be aware and talk about where their modes are and aren't and what it means for them. It is always concerning to me if somebody pretends like it's still 2024 because it's not.
Yeah, that's super fair. Um, for the next one, I want to do like a quick round, and we can start with you, Ben. Are there any categories within AI that you're more cautious about right now, and why?
I mean, I think I'm pretty category agnostic. I mean, if you look at kind of a specifical vertical agents, like I think it's a very crowded space. So it's, other areas are more crowded. So you're going to hold those founders to a higher bar, but you know, in general, not really. I mean, I do tend to skew towards founders that are tackling things that are a little further ahead of the curve or, working kind of or thinking orthogonal to where everyone else is going. I think those are the interesting spaces. But, I mean, I think at the end of the day, just the sheer act of building something, putting yourself out into market is where you discover what the real problems are. And that's those kind of unexpected discoveries are where you end up with the real value. So, it's much more to me about the process than any particular category.
Philip, would you agree with that as well?
Definitely. Perhaps I'd add to that, that more than categories, I'm trying to understand how durable, if it's a company with traction, and that's why I'm particularly interested, I'm trying to understand how durable that revenue is. In a world where getting to six or even seven figure ARR, is possible in a matter of months. How many customers do they have? What types of customers? What type of retention? Are they thinking about cohort analysis? Um, and being wary because as it is very possible to ramp revenue very quickly, it's also possible to lose revenue very quickly, either because your product isn't loved or because somebody else built something better.
Thanks. Nate and JJ, anything to add there?
Think-
Go
Go
for it,
ahead.
JJ. You got it.
No, you go ahead, Nate.
Okay. I mean, I can be like really nitpicky on a couple categories. Like there are often many like AI native marketing tools and, AI native sales tooling. I mean, personally, I'm not that excited about like the next AI video tool or like another way to send email at scale with AI. Like, so there are some certain like subsections that I'm just not that excited about. I think maybe to Philip's point, that like they're not that durable. They're often kind of moment in time. And I'm not sure you can build big businesses around them because they often feel like still point solutions. And I just don't see how they could cross that chasm to actually become like the enterprise choice or a big company
Mm.
that could deliver on, let's say, like a $10 billion outcome. But yeah, that would be my very nitpicky specific answer around sections I'm a little cautious about.
Thanks, Nate. I appreciate the difference in thought that we're seeing here. JJ, any additional thoughts?
Sure. I think most industries are still, everything's pretty still fair game. I have a hard time thinking of something I would absolutely refuse to look at. I probably focus now more on like ethics or like, am I going to be, if this company is wildly successful, not just will I make money, but like, am I happier with this world now? It
Mm.
is, talking about it's easier than ever to build. It is also easier than ever to build companies that can be rent seeking. And some of them can be great businesses. It just doesn't bring me joy to be having to root for a company that I think is actively making the world worse. And there's a pretty high bar for that, right? Lots of companies people may dislike, but are still providing value to someone. I'm talking about truly only net negative on society. So those I probably too, but that's very, very few. Maybe one per batch max.
Yeah, that's an interesting data point to add in there as well. Shifting the conversation a little bit from AI, I want to talk more about the broader macro environment that might be top of mind for some investors, and hear about how that's showing up or not, and how you're approaching this batch. So, Philip, we'll start with you here. We have tariffs, rate uncertainty, slower enterprise sales cycle. How does that macro backdrop actually change how you're approaching this batch, if at all? Or is that something that you not really pay attention to at such an early stage?
Um, the easy and mostly true answer is to say that I tune it out. You can't predict macro 5+ years out. Having uh, having lived through the very real implications of the tariff war that started 12 months ago, and it contributed massively towards challenges for the past YC company that I was running. Um, the potential impact for customer adoption and for future funding, you know, should the startup need it, which is almost certain that they will, is very real. So if the idea is in that possible crossfire, China dependent supply chain, something that does feel like a pretty sustained macro shift. I want to know how sophisticated and aware is the founder of that. Do they have a sense or an insight in a potential contingency plan? Um, as for things like rate uncertainties and slower enterprise sales cycles, I think those are examples of much more fluid. I don't see them quite as much as signal.
Super fair, thank you. Nate, feel free to go ahead.
Yeah, maybe I'm gonna take this question like in the optimistic, maybe a little bit more optimistically. Like there are certain some macro tailwinds that like companies are benefiting from across like a whole bunch of different verticals. But as far as like macro headwinds or uncertainty, I don't think too much about it, and I don't think the founders think too much about it either. Like starting a startup is already very hard. Like I don't think most founders at this stage are too worried about interest rates, nor do I think it probably impacts their success over, let's say, a 10 or a 12-year horizon. Um, I think, yeah, no, want to just focus on great founders, great companies, and then if there is a macro tailwind, even better. But not too worried about tariffs or rates or something like that, that neither I or the founder probably really will be impacted by at this stage.
Fair. And turning now from the founder and looking more towards like the investors, JJ, what would you say to someone who's asking whether now is actually a good time to be deploying into early stage, given the environment that we're in?
I think now is a great time to invest in early stage. Sometimes it's counterintuitive. It's like, oh, everything feels maybe a little bubbly, or the bubbly is not the word I want to use, frothy. Um, but in VC, some of the best investors, legendary venture capitalists I've spoken to, they all tend to say that most of VC returns are made in frothy environments. Um, and what we're seeing now is really, really good companies that are growing bigger than ever at valuations. Like it used to be that a unicorn, $1 billion valuation was like a rare and crazy occurrence. And now we're seeing companies hit 15, 20 billion. And that's like not even including, the frontier labs who are nearing a trillion. Um, I think literally today, like Kalshi, which is a YC company, raised at a $22 billion valuation. So yes, check sizes prices have gone up, but when we're talking about companies, their valuations going 20x, they're not only a good deal, they might even be a better deal as long as they're picking the right companies than it was back then. So to me, I think that it's a fallacy to not invest now. If you like this space and are willing to take on the risk, no different than in the public markets when people say, "Oh, the market's overvalued. I'm just going to wait." It's different, but there are some, if you squint properly, time and market versus beats timing the market. And for us, it's great companies are the right investment, kind of no matter when they come out.
Thanks, JJ. Ben, anything to add there?
I think I'll look at it, kind of combine a bit of the macro. If we look at the broader world right now, I'd say it is a bit messy. And so if I'm putting on my financial advisor hat, that's really when you say, all right, well, what's my allocation strategy? Because that's really going to matter. How do you go through good times and bad times or uncertain times? When you talk to, say, larger LPs, they're not asking, how do I avoid all the risk that's out in that world? They're asking, what risks should I be assigning up for? And basically, how should I be executing that strategy? So, we've got public markets, as JJ mentioned. They're very liquid, but it's also becoming increasingly concentrated in, a relatively small number of companies that have, their volatility really disproportionately drives market movements. And now we're moving basically over into private markets. And, if you start to break down categories and you think about it, like much of the private markets is really just kind of optimizing assets that already exist. Um, we're repricing, we're restructuring, we're leveraging things up, we're transferring risks back and forth. It's all very useful work, but it's not actually creating something new. And I think that's where you look at early stage venture. It's very unique and very different. The business of early stage venture in general is funding businesses that do not exist yet. And I think it's one of the few places that you can take capital and basically underwrite the, entirely new and novel creation of new venture value, and so forth. And, you're able to do it in a situation where, the broader market is completely oblivious. So you're doing it well before like the market's actually going to realize, well, what is the ultimate value out there? And that's where you capture these, gross returns. So I wouldn't tell an LP that I think you should just, indiscriminately throw money around. But, at the same time, if you think about it, like, sitting out on the early stage market, like that's not a neutral position. That's you taking an active position that you believe nothing exciting is going to be happening right now in those markets. And, put that against the backdrop of AI, I think that's a very, risky position to take. So that's my thoughts.
Yeah, Ben, and I think that that is a great transition to talk about what some of that value and what those returns look like for early stage venture and getting involved in that. So I want to shift to that topic, and we'll start with JJ here. The IPO market has been slower, and exits do take longer than people expect. So how do you think about the return timeline for demo day funds, and how has that changed since you began investing in YC companies?
I think the return timeline in venture is lengthy and uncertain and always has been. So I think, even longer ago when the expectation was maybe a bit earlier, you had to always come in and say, I'm going for really, really big outcomes and I don't know how long they're going to take, whether it's 5 years, 7 years, 15 years. What has changed? Yes, fewer IPOs, but what has also changed since then is there is now a much more liquid secondary market, to the point where there's almost like a semi-public private market. And what that means for us as fund leads, if we invest in companies that do really, like, let's take a Stripe. Stripe is not launching today, but if you are an investor in Stripe, you are still not liquid. They have not IPO'd, but there has been an ongoing and repeatable opportunity for most people to liquidate some portion of their holdings if they'd like to. It's not guaranteed and it's not everyone, but what is different is that we're not stuck here sitting and waiting forever with no control. And that means that we probably will still want to wait. Stripe, just as an example, picking on them, has continued to grow. But if we find ourselves in a position where we want to exit a position in total or in part, I expect to have the opportunities to do so, even if that company stays private.
Yeah, that's a great point. I think the secondary piece is growing, as you mentioned. Ben, any additional thoughts there?
Um, I mean, I don't think, it's, to JJ's point and so forth, I think the secondary market is a very good point. I think the way I think about it is like, I mean, the company building timeline has not particularly, changed all that much. I mean, I think AI, you know, has and will accelerate in terms of, tighter product cycles and, earlier revenue and so forth. So there might be, forward looking a slightly different characteristic than if we look historically looking. But ultimately building a large successful company takes time. But the model I really think is you've got kind of two clocks going on here. You've got the building clock, um, and then you have kind of the harvesting clock on it. And the building clock is where the actual value gets created. The harvesting clock, that's the IPO market, that's M&A. The secondary markets, like, I mean, they're not immune to macro influences. That's where you turn that value back into cash. So you have the ability to kind of exchange. And so, it's the harvesting clock that again moves with the macro cycles. Um, and I think there's a little bit of, conditioning because if we look back to like 2021, all right, we've got to recognize like that was the anomaly and not the baseline for liquidity in that space. I mean, like rates were near zero. With capital pretty much everywhere, valuations were running up. Um, you had a very wide open exit window. But moments rate rise that kind of, compresses and so forth. And, companies start being a lot more selective about when they exit or, M&A side, who they acquire, and so forth. And so, but that doesn't mean like I guess, the value creation has stopped. That's always been ongoing inside the market. It just means that it's happening in private. Um, and so, I guess I mean, I think the thing that you understand about like demo day funds and is key to it is like we are investing at the formation of it. You know, in the future, it's going to be the macro conditions when we actually, take, the harvesting and, kind of waiting around that is it's not really your signal about when to start planting your seeds in this metaphor. I mean, once the pathway to liquidity is, obvious or basically, foregone conclusion, like the portfolios that are going to realize value at that point in time have already been baked. They've already been built. And so, venture investing is you've got to be in early, and you're going to then get the premium by waiting to when it's time to harvest the crop.
Super fair, Ben. And I think the piece about creating that value in private is an important one. I'm curious to hear from you, Philip. Where do you think that value creation is won or lost at the earliest stage? And where does that pathway to liquidity start to actually happen?
Um, I go back to the fundamentals with that sort of thing. Like if we need to place our bets early before we know what the heck is going to happen with a cycle over the lifetime of this company, on average, it will be 7 to 12 years, sort of big range, but that range. Um, there could be 1 or 2 cycles that happen in between. And so I think it is the same thing, going back to the fundamentals that we keep talking about, the founder quality, you know, these are the things we look for. The rate of learning in that founder, if there isn't some breakout early traction, the quality of the market, of, the stickiness of the revenue of the business model. Um, and then also I think having a broad enough exposure, to have a chance at getting those outlier winners. Um, I often get the question around valuation sensitivity and how important that is. And um, I would say there is a market within YC that I feel very comfortable investing in. If it's outside of that range, then there has to be something exceptional, something really, like this founder has already sold a very big company. Their likelihood of raising a really significant next round in a short period of time. We had one example like that a year ago in the quantum space. Those are the rare examples when I would go outside of the expected band.
Yeah, fair. Nate, any additional thoughts there on that question?
Yeah, where long-term returns are really won at the earliest stage. Well, I think picking the right companies is one thing, but like we also have to get in those deals and actually invest in those companies. You can't just pick them. You do have to often win them and get that allocation. And I think that's something that we all here do a really good job of, just being YC alum, being active YC investors. We're often at the front of the line in terms of getting allocation in some of these very competitive deals. To Ben's point, like I do think YC and these YC funds allow us to build, diversified portfolios and really tight time bands, which I think is great for LPs. But also too, like being early in these deals is so important because being early or 2 days late can sometimes be the difference in terms of 100% difference in the valuation that we might actually be entering at. And so we do need to move quick. We need to be at the front of the line. We need to get the allocation. And then we also need to get in at the best price that we can for our LPs to really maximize returns over the long term.
Thanks, Nate. Building on that piece of the LP question here, Ben, what is one thing you wish more LPs understood about how early stage venture works and how these returns start to come through by investing early?
Um, I think, you know, a lot of LPs do understand this, but I think in general, like what I think strikes most people is, just I say how unforgiving the spread is between an okay company and your breakout companies when you're going to early stage venture. I mean, unlike traditional markets, like this is not a game of batting averages. Um, we can be directionally right, we can like the founder, we can think what they're up to is interesting, but at the end of the day, if you don't get allocation, if you're not in the company, um, you know, none of it pretty much matters if it's the winning company. There's no partial credit for not owning the breakout business out there. And I think, this is where diversification really comes into play. And I think this is kind of unique for this particular asset class. I mean, mostly traditional asset class. If you go wider up to a certain point, you start to dilute your returns. But in this situation where things are pre-filtered, you've got an exceptionally high quality power law kind of distribution as you do in YC. Going broad is not really, I want to say, an absence of judgment. I mean, it's how you give yourself exposure to, let the power law work for you. Um, the edge isn't kind of forecasting here. We're not trying to make perfect claims about the prediction of the future. It's really the edge is, to its Nate's credit, to access its judgment under highly uncertain environments. It's portfolio construction that goes in there. And I think, ultimately that what makes this, demo day program quite unique is, you can get capital really into this, very dense pool of potential outliers with a group of people that, have the relationship, have the context to actually get in the deal, kind of know where that kind of, slightly, you know, middle zone is. Because I mean, at the end of the day, like venture does not pay for just being, right opinionally about it. Like you need ownership in the breakout business if you want to get those returns.
Thanks, Ben. Philip, any additional thoughts there?
I totally agree that I think LPs by and large have a really good sense. And I love it when my LPs reach out, want to have a conversation, have questions. So by all means, reach out. Um, I think it's important to not be overly swayed by the early hot companies. It's important to pay attention, to talk to them, and to make a quick assessment and get into most of them. Um, but more often than not, it takes companies time to find their stride. And there's a degree of resilience and long-term obsession that we're looking for. You've heard that sort of theme come up time and again. The thing that I'll close with is um, hopefully prospective LPs understand how significant the YC advantage is. To quote some data from Carta and Orange Collective that Gary Tan um, published about a year ago, of funds that build a portfolio of YC companies, the top 25% of those achieve a TVPI of 8x. That's compared to 1.6 for the rest of all of venture. The median 50% of companies that are building a portfolio of YC companies, sorry, funds that are building a portfolio of YC companies, have a TVPI of 5x compared to 1.2x for the rest of venture. This is far and away the best pool and crop of founders and companies who, by virtue of being in the program, have an enormous accelerant. I mean, the peer pressure and the intensity and the like launch fuel that YC gives you is unlike anything they will experience at any other moment in their careers. Um, and in a world where we are investing in power law outcomes and success is binary. It's either very successful or it's not. And that's the game that we're playing. We all know we're playing that game. Um, any sort of significant boost that you can have at the beginning to build inertia greatly increases the odds of success. And, those top quarter, top 25% and median figures illustrate that better than almost any other piece of data I've come across.
Yeah. Thanks, Philip. I think we are at the end of all of our questions. We did receive one pre-submitted question that I'd like to pose to the group. It builds a little bit on what, Ben, you were saying about having judgment in your portfolio and how to build that. So the question we received was, AI is changing how you source and analyze startup deals, but your real edge as an investor is still uniquely human. Judgment about people, context, and values. Looking at the next 5 to 10 years, in what types of deals do you expect AI to be most helpful? And in what situations do you think pure human judgment will matter even more? Ben, I see that you came off mute, so I'll let you start responding to that.
Oh, raise my hand implicitly. I think, I think there's always is human judgment that goes into this. I mean, like we know building portfolios and having access, have important, implications on success with this. I mean, being able to get to a pool of companies that is in essence self-selecting as an outlier, which is what YC, funnel offers, I mean, that is what is the important piece here. I think there is, I mean, I've looked at it. I mean, AI is new today, but I mean, have been in capital markets starting in 2003 when quant trading was just the case. And it is, there's always been data-driven ways to eke out an edge in this space. I do not think that actually ultimately applies to investors or to the venture investor space very well because at the end of the day, venture investing is about relationships. And, you know, that is a human to human connection. My AI is not going to sell the founder and say, you should take your capital. Why Nate, JJ, Philip, myself can get capital into some of the hottest companies at preferential valuations than everyone else is because we have the network and we have the reputation with inside the space. And that's the same reason that we bring, these demo day programs to everyone here.
Thanks, Ben. JJ, anything you'd like to add there?
Yeah, I think AI is not doing our analysis for us. It's a tool. I mean, if we could perfectly encode the way we judge companies into the AI, I'm frankly fine with that. I don't, maybe Ben knows how to do that. I don't know how to do that. But to Ben's point, like the actual judgment, meeting, assessing is only one part of it. And just as much, if not a bigger part, frankly, is like Ben's point, getting access, getting information that others don't have, getting access at all to have the opportunity, and then getting into the deal. And that is something we have because we have the YC relationships, we have reputations among the founders, we have a good track record. We have a history of providing great help such that other founders refer us. Even sometimes, honestly, certain deals are kind of obvious. We're like, this company is great and everybody wants it. And you don't, in AI could also tell you that. What the AI is not going to do is going to get the founder to say, yes, I want JJ, I want Ben, I want Philip in this deal. And so I think that's why maybe this is surprising to some LPs, why none of the fund leads tend to really think about this that much, because the battle we're really fighting is making sure we're getting in.
Yeah. Philip, Nate, any final thoughts?
I think AI is, with each batch that goes on, we're using it more and more in my process. It helps with coverage and speed, front end work, maybe making sure that we're talking to the right people rather than assessing that as much on the call. But the lion's share and for a long time is a human to human interaction. And then, that's where you also build a relationship, because right now it's all great. People are at the beginning of their journeys. In a year, 2 years, there's co-founder issues, can't talk about this with anybody else in my company. Um, that's where the fact that we are all former founders, running companies again, um, has an outsized advantage.
Thanks, Philip, and thank God for maintaining human interaction. Go ahead, Nate.
Oh, you know what? For what it's worth, I would invest in JJAI. So maybe at some point that'll happen. Yeah, I mean, it's hard to follow up these answers. Well said, Ben, JJ, Philip. Yeah, it's absolutely still a human to human business. More times than not in a batch process, I am selling Nate as a helpful partner to these founders. And that is quite important. But yeah, like the AI tooling can be helpful for getting context. It can be helpful for doing that due diligence before the call, so that we can make quick decisions then on the call. But yeah, this is a team game. It's a relationship business, and we are absolutely selling ourselves, and our reputation helps to do that too.
For sure. Well, that's time. Thank you all so much for sharing your background and insights. The LPs or attendees that join this call can find additional information about each of these offerings on the fund pages, the fund governing docs, and our demo day website, which I think we've already dropped in the chat. As a reminder, the minimum to invest per fund is 5,000 with an expected closing date of June 5th for all funds. So investments will be accepted until the close date or the funds reach capacity. Thanks again to everyone who tuned in today. And if you submitted a question we couldn't get to, please send it to demoday@angellist.com and our team will follow up with you directly. Have a great rest of your day. And thank you again, Ben, JJ, Philip, and Nate. Bye, everyone.